We have changed our long-term view. I think platinum has a number of headwinds. We're not so positive on uranium mining companies because central banks don't say, I want to buy X ounces of gold. They say, I want to put X dollars of my monetary reserves into gold. With the gold price sharply higher, central banks are buying less gold with the same amount of money.
Okay, ladies and gentlemen, so today we have Jeffrey Christian back on the show, and today we will look at the US economy, commodities, precious metals, and many other very interesting topics. So Jeff, thank you so much for being back on the show.
It's great to see you again, Vladislav.
Very happy to have you back, Jeff. I like to start by looking at the macro picture first. So if we could talk about the US economy and look at some of the things that you're currently paying attention to.
Okay, yeah, I spent the weekend with some old friends, and the lady of the house kept asking me to tell her something optimistic. I said I can't. We've struggled over the last 8 months, 11 months, as have most people, with our expectations, our longer term expectations for the U.S. and global economy and political system. And it's been a very volatile time, which has been reflected in the metals markets too. Now, if you go back a few years, for several years, CPM Group has been predicting or projecting a severe recession sometime between 2025 and 2027. And we haven't seen one yet, although it'll be very interesting to see the economic data for the third quarter as it starts to come out over the next few weeks. We have changed our long-term view, and we take our economic projections out 10 years. If you look at the IMF or the World Bank or the OECD, they tend to go out 2 years or so, but we go out 10 years, which is really a very perilous thing to do. But we had been saying for several years, we thought we'd see a severe recession in this current time period, followed by an anemic recovery. And that in the recovery phase and the post-recovery expansion period of the economic cycle, we wouldn't see growth in the United States, Europe, and the rest of the world as strongly as we've seen in post-recession periods, really since the 1980s and 1990s. We've changed our view now, and we're looking at a less severe recession, possibly still starting this year. It could be, emerging now, but most likely in 2026, and an even weaker economic recovery. So what we're saying is we think that the pain may be less severe in 2026 than we had expected, but we think that the pain will be more protracted over several years. And it reflects our view that the political and social and economic structures and financial structures are in a very weakened state. And we don't necessarily see policymakers making the right decisions to get us into a stronger growth period.
And Jeff, if people look at the stock market at the current valuations, it doesn't look like most investors are worried about this possible recession, right?
But the correlation between the stock market and economic activity is pretty poor. My old boss in the 1980s used to say that the stock market had predicted 14 of the last 3 recessions, right? And the same is true on the high side. What you're looking at with the stock market right now is, and it ties in with what I was saying about, the severe uncertainty about what the economic environment is, not just at CPM Group, but on a global basis. there's more risk at large and greater uncertainty and anxiety about the future economic trends than at any point since December 1941. And part of the problem is this enormous amount of debt, not just with the US government, but other sovereigns, corporations, and individuals, consumers, and investors. And the debt has been underwritten by central banks by force. The central banks have had their policy usurped by the fiscal policy of governments. The fiscal policy has been so profligate that the central banks have to sort of back away from what they would be doing and focus on keeping the economies from collapsing because of profligate fiscal policy. And as a result of that, you have this enormous amount of money, and the vast majority of it is in US dollars and US Treasury bonds. We haven't seen people abandoning the bond and the dollars the way some people say. If you look at it, foreign holdings of US Treasury securities are at record levels, and they've been rising at 10 or more than 10% per annum over the last couple of years. That's not because people want the treasuries. It's because the treasuries are seen as the least risky debt structures. You have this enormous pool of money, and you have more of that money in cash and cash equivalents, bank CDs, treasury bills, treasury notes, than ever before. And so as a result, you have financial investors, financial market participants doing two things. A, they're investing in stocks because, yes, we haven't seen a recession. We've had mixed economic conditions, and you got to put your money someplace. People are paying these fund managers to manage the funds, not to sit on bank CDs and treasuries. So you've got to do something. You've got to deploy this capital that you've been paid to deploy. And so there's money going into the stock market. At the same time, you've seen a tremendous amount of money go into gold and silver. And people will say, well, don't gold and silver move in the opposite direction of the stock market? And the answer is no. The correlation over time is zero, which is why gold and silver are such good portfolio diversifiers. So you've got a situation right now where the world is awash in cash, and the world is simultaneously awash in anxiety. And investors are saying, okay, I'm going to put money in the stock market because I have all this cash to deploy, but I'm also buying gold and silver because I do think that this is a house of cards. And while it hasn't collapsed in the last 40, 50 years, that doesn't mean it won't. We don't buy the garbage about collapsing economies. What we see are economic and political stringencies, tough times, recessions, severe recessions at times, inflation, but we don't necessarily see a collapse. And I think most financial market participants agree with that. And so they're investing in the stock market and keeping it high, but they're also investing in gold and silver.
Right. And Jeff, how would you expect the stock market to perform if we do go into a recession?
I think the stock market would fall sharply, 20% or more, and then it would recover. And again, it would recover partly because there is so much money that is looking for investments. And if you saw the stock market fall 20% or 30% or even 40%, you would see a lot of people saying these things are now 40% cheaper than they were. So I'm going to pile in. If you go back to 2000, 2001, we had a short, shallow recession, but we had a number of financial crises. And the New York Stock Exchange index fell, I believe, 43%, and NASDAQ fell 86%. It's just an enormous decline in the stock market. And the reaction of investors was, there are bargains to be had.
Just a very quick break, guys. So I've spent the last 12 months creating this course, Wealth Building Blueprint. I've put an unbelievable amount of effort into it. I cover investing, trading, speculating, business. The course is perfect for people who are still relatively new to this wealth building process. And I also offer 3 days money back guarantee. No questions asked. If there's absolutely anything that you're not happy with, you will get your money back. There's also a private community where you can ask me any questions, you can talk between each other, you can share news and things like that. The link will be in the description. Right now the course is at a 70% discount, and let's continue with the video. That's a good point, Jeff. So the last time we spoke, gold was about $600 cheaper per ounce. A few years ago, that would have been a tremendous move, but right now it doesn't seem that big of a deal. So if we look at this performance, Jeff, what do you believe are some of the factors that pushed gold even since the last time we spoke, and how do you expect gold to perform, let's say, for the next 12 months?
Yeah. The major factor is investment demand. And we've seen this enormous amount of investment demand for gold. I'm not quite sure what our final figures will be for 2025 net investment demand on physical gold, but it's going to be high. It's going to be one of the higher levels that we've seen in history. And that's been driving the gold price high. The model that we have is that investment demand is driven by exogenous variables, economic and political and social and financial factors are the primary things that investors look at and say, I should buy more or less gold. They're saying, okay, I should be buying more gold. That drives the price higher. The higher gold price then drives mine production to expand, which you're starting to see some of. It drives increased secondary recovery from scrap, old jewelry, old decorative items, and things like that, as well as electronics. And it also reduces fabrication demand. So we're seeing lower fabrication demand this year and last year, and it's still plugging away. It's not plunging. You're seeing higher scrap recovery, but the real kicker is that investment demand. You're also seeing central banks continuing to buy, but they're not buying 1,000 tons or 30 million ounces the way promoters say. They're buying right now, I think, through September, central banks were net buyers, probably on the pace for like 7 or 8 million ounces this year, not 30 million ounces. And that's down a little bit from last year. And that reflects two things. One is the higher price, because central banks don't say, I want to buy X ounces of gold. They say, I want to put X dollars of my monetary reserves into gold. So with the gold price sharply higher, I mean, it was $2,600 at the start of this year. It's $4,080 now. With the gold price sharply higher, central banks are buying less gold with the same amount of money. So central bank demand is down. There's a lot of investors who are drinking the Kool-Aid and thinking that central banks are secretly buying 33 million ounces of gold. They'll be disappointed, perhaps at some point. The reality is that, so it really comes down to investment demand. Now, I'll go forward in a second, but I just want to back up with the central banks. Central bank gold activity, along with a lot of other stuff, used to be secret. The central banks, starting with Paul Volcker and Alan Greenspan in the 1980s, started pushing for greater transparency and to be more forthcoming. Central banks used to be very secretive about all of their stuff. They're more transparent. In addition to that, they were very secretive about their gold trades. And that lasted into and through the 90s. But starting in 1999 and then going forward over the next decade, you saw central banks with the Bank for International Settlement and the International Monetary Fund coming to agreement to increase their transparency and to have standardized accounting for their monetary reserves and to accurately and timely report their monetary reserves. And by and large, central banks are doing that now. So for someone to say there's like, oh yeah, central banks are reporting that they're buying 8 million ounces of gold, but they're really buying 30 plus million ounces of gold, that person is implying that at least some central banks are abrogating their agreed upon responsibilities to have transparent and unified accounting. And I would rather believe that all of these central banks, the IMF and the BIS, are perhaps being more honest than the promoters saying you should be buying gold, Mr. Investor, because look, the central banks are buying all this gold. Oh, well, yeah, they're not reporting it, but believe me, they are. I'd rather believe the central banks being honest than a gold promoter. Now, going forward the next 12 months, we expect the volatility. We've seen increased volatility since late August, since the Kansas City Jackson Hole conference. We've seen increased volatility. We think that's going to continue. It could dissipate. Our expectation is that the prices will continue to be volatile and they'll continue to move higher. Our expectation is that we will have more hostile economic and political conditions in the first half of 2026 than we've had in 2025. As terrible as 2025 has been in terms of the uncertainties and issues, we think 2026 is going to be worse. And that worse economic and political environment is going to cause investors to buy more gold, even at record prices.
Mm-hmm. Very interesting, Jeff. So if we look at the sentiment, you believe that the sentiment is quite high, so people are interested in gold, but then would that not indicate that we are getting close to the top? Or so I suppose what I'm asking, how would we measure the sentiment and try to identify the peak?
Yeah. Well, one of the reasons why a lot of people like gold and silver are the secrecy that they afford. And as one famous investor once said, anybody who tries to follow and ride my coattails, they will always be behind the schedule and they'll be reacting to what I've done in the past, not to what I'm doing now. And that's true. And when you get into the gold market, there is this tremendous secrecy. So you look at the shadows of what the investors are doing, right? And that's really where we're at. Whether or not we're at the middle or end of a cyclical uptrend is not clear. The relationship between gold price changes and economic recessions and recoveries is mixed. Sometimes the gold price peaks before the recession starts, as in 1979, 1980. Other times it peaks after the recession has been ended. And then in that very interesting and telling and I think important period from 2002 to 2012, 2011, you saw gold rising sharply before, during, and after the recession. And I think that that's what we're looking at now. We've been saying for 25 years now that we're in a new period for gold with an upward shift in the investment demand curve where more investors are buying more gold at higher prices for decades, not for 1 or 2 years like in the past, but for decades. And we've been seeing that since 2002. And that's what's been going on. And we had this long period of time, 2002 to 2011. Then we had it come down to 2015 and move sideways for 4 years. And now it's up again. If you look at the increase since 2019 in dollar terms, it's far larger than was the increase from 2002 to 2011. But if you look at it in percentage terms, it's half of what it was. So when you start thinking, well, does this thing have a lot of steam on a purely price technical chart level? Yes, it has a lot of steam. But we look at the underlying economic and political environment, and we don't see that improving anytime soon. So we think that investors will continue to be buyers of gold, driving the prices higher, not just in 2026, but possibly into 2027, depending on what happens 2 to 3 years from now, economically and politically. Maybe the gold price comes down. But there, I have to stress, there are these enormous uncertainties and the risks. Where are you going to say the timing changes? Could it be in the first quarter of next year when we'll see certain court rulings related to things that the Trump administration is doing? It could be. There's some seasonal price factors there too. There's the question of where we're going to be in the economy. What's fabrication demand going to be doing? What's scrap going to be doing? It could be in the final quarter of 2026 when we have the congressional midterm elections in the United States. In between, there could be, a resolution of the Ukraine-Russian war. There could be a new war in Latin America. I mean, the United States is threatening to attack Venezuela, threatening to attack Nigeria. The uncertainties are so great right now that saying when do we think things will get better and turn around is really a treacherous thing to do. And as I said, on the weekend, I assured my friend's wife that I don't really have a lot of optimistic things to say about the economic and political outlook.
If we look, Jeff, at silver, so is it more the sentiment and silver being viewed as, gold's younger sister or brother that matters, or is it the fundamentals that drive the price of the metal?
It's really a mixture. I mean, obviously, it's sentiment and investment demand. Investment demand is a fundamental, and it's the key fundamental determinant of silver prices. But with silver, fabrication demand trends and the supply demand balance are much more important. And we've seen shortages in London, we've seen shortages in Mumbai and Hyderabad. There's a lot of silver out there, but there's a lot of money out there. And the people who are owning the silver, a lot of them are saying, I'm not necessarily ready to sell. I mean, we have most of our businesses with investors, either institutional investors or high net worth individuals or family offices. And they were listening to us talking about gold and silver prices getting to very high levels in 2025, 2026. And over the last year, the conversation has been very universal. You guys were right. Where the prices have risen to where you thought they would be when you thought they would be here, but we don't want to sell. We don't want to take profits because of the ongoing uncertainties. So we've been doing a lot of hedging for clients, for investment clients, as opposed to mining companies. We've been doing a lot of hedging where we say, okay, keep your physical gold and silver, but buy some options to protect yourself from a downward trend at some point. But when that point is, we don't know. But it's really that investment demand that's been driving silver. Investment demand got very low 2019 or so, and it's picked up sharply over the last 2 or 3 years. And we think it's going to pick up even more next year.
Thanks for that, Jeff. And if you could remind us on how you look at the relationship between silver's price and the supply and demand fundamentals, because most people believe that it's all about the deficits, but you have a slightly different view.
The deficit, the supply demand balance is important, but what's really important is the availability of metal, either from newly refined silver coming in from mines and secondary recovery of scrap, versus demand from both industrial users and investors. And what the key determinant for the price is when investors want more silver than is available, readily available from newly refined supply and above ground inventories, they will bid the price up. And that's what's been happening the last 2 years, and especially this year, is that investors have said, I want more silver than is readily available from newly refined metal coming into the market relative to fabrication demand. Fabrication demand has held up relatively well in the industrialized world. It's been off in India, and I believe it's off in China too this year. But the metal that is readily available to investors is less than the amount, we have a surplus in our supply demand balance. There's metal left over for investors, but investors have wanted even more metal than is readily available. So they have to go to people who are owning and holding refined metal and say, I want your metal. Those investors that are holding the metal have been saying, I don't want to sell. So the price has gone from, $28 to $30 to 50. As we talk, it's $50.72. That price increase reflects new investors bidding the price up to levels where older investors say, okay, look, I bought the stuff at $15 5 years ago. I'll sell. Yeah. And that's really the kicker in terms of the relationship between the physical supply and demand and the price.
And Jeff, when I was looking at historical charts, percentage-wise, silver usually outperforms gold during these bull markets. Would you expect something similar to happen this time around as well?
Yeah. I mean, the silver market's like 1/10 of the size in dollar value as the gold market. And so gold's much more of a universally recognized financial investment. But because of the smaller size of the silver market, its price tends to be more volatile. So it rises further faster than gold and it falls further faster than gold.
Mhm. And Jeff, so with that being said, things look still relatively bullish for the precious metals. Would that make you interested in the mining stocks as well because they give leverage to the price?
The right mining stocks. Yeah, the issue when you get into the mining industry, you have all sorts of risks and issues you need to pay attention to beyond those of the physical commodity, management risks, geologic risks, mining and metallurgical risks, government and regulatory issues, and so you have a lot more risks there. And you have a lot of people, smaller companies that don't have the capital and management to drive those projects forward. So, then you have at the other end of the spectrum, you have these very large mining companies that any new discoveries, new expansions of their mines, increased output is relatively small compared to their whole. And in the middle, you have smaller companies and middle-sized mining companies that actually can be very attractive. And they can be attractive because they're smaller and more agile, and a new mine coming on stream or a new shaft coming on stream has a greater impact on their revenue in percentage terms. So they can be good, better, more attractive that way. And they can also be more attractive because they are targets for those large companies that are constantly looking to replace the reserves that they deplete as they mine. So, you have to be very selective, I think, with your choices of mining companies. But I do think that, with the higher gold prices and higher silver prices, clearly these companies, there are some of these companies that definitely make sense on a short-term basis, and there are other companies within those industries that make sense on a longer-term basis too.
Yes, and those margins right now look really good. We just need to hope that the management don't do what they've done last time, and don't mess this up. And so, Jeff, if you look at platinum, would you expect platinum to follow gold and silver?
Platinum is following a little bit, but platinum is primarily an industrial metal. The major use is auto catalysts. The auto industry is facing some cyclical problems as well as some long-term secular shifts. The rise of electric vehicles that don't use platinum group metals. But now we're seeing a shift away from battery electric vehicles to hybrid vehicles, which do use platinum and palladium. So there's some technical shifts, secular shifts. There's also shifts in the demographics of automotive demand from consumers. So I think platinum has a number of headwinds, and there are people who see it more as an industrial metal. And they say, if I'm investing in gold and silver because I'm worried about the financial world, I'm going to invest in gold and silver. And platinum is more of an industrial metal, so I won't be there.
That makes sense. And if we look at things like copper, uranium, would you be bullish on them for the long term as well, purely from the fundamental perspective and where the world is going?
Well, we have been bullish on copper. My colleague Carlos Sanchez is working on updating our 10-year copper projections now. So I'm a little bit hesitant to say, but I suspect and I assume from the work I've seen and just the state of the economy, I assume that we will remain positive on copper. We're not so positive on uranium mining companies because there is now resumed interest in nuclear power, which we have been advocating for several years now. Nuclear power technologies have changed and improved dramatically, but the political and social understanding has lagged that. And it's still lagging that. So people are now turning toward being more pro-nuclear power because of climate change and such, without understanding that nuclear power is a lot safer and more powerful than it used to be. I mean, if you look at the United States, we have had an enormous increase in the amount of electricity generated by nuclear power over the last 45 years without building maybe one new nuclear reactor. But the existing reactors, which were scheduled to be obsolete by now, have been re-engineered and new equipment has been put in, and they're operating at much higher levels, producing much more electricity than they used to in a safer way. But the public doesn't know that. But our problem, or the big thing that we come down vis-a-vis uranium mining is that if the US government and some other governments changed their regulations and allowed you to reprocess spent nuclear fuel, you don't need to mine more uranium. There's enough uranium that could be reprocessed and reused in all of that spent fuel that's sitting around in drums waiting to find a home underground to meet the future needs, even with the strong growth that we're seeing. I mean, we're seeing very strong growth in nuclear power generation in China and in India and in a number of other countries too. The developed nations are lagging in that respect, but they will probably play catch up at some point. But the reality is that you could have a big growth in nuclear power generation without needing more new mining of uranium. So I'm not particularly interested in uranium mining. I did own some uranium mining shares, but I've sold them over the last several years. And I'm much more interested in companies that have new and innovative nuclear power technologies.
Right. So, Jeff, we covered a lot. These are all the questions I had. Is there anything else that maybe you would like to mention that we haven't covered?
I think we pretty much covered it all. Yeah, I mean, it's the macroeconomic and political environment, and then it's the fundamentals of each metal.
That's perfect, Jeff. Thank you so much for your time. I enjoyed our conversation, and I'm looking forward to having you back on the show.
Well, thank you for inviting me and having me as a guest. And anytime I'm available.